Hello, all. Happy Saturday and wishing you all a fun filled Sunday. Thank you for joining us today. Can banks continue to have high sectoral weights in the index? What happened to the US bank weight in S&P 500? Will it play out in India too? Get answers to this and more in today's presentation headed by Sanjay Kumar, Senior Research Analyst. Now he'll be taking over the presentation. Thank you.
Thanks, Tarun. Good morning, everyone. Welcome to the TRUBLU webinar. Before we get started, just a brief of what we discussed in our last TRUBLU webinar. So we spoke about cycles and compounding and how cycles work in markets. Just a brief. So in 2000, all the IT companies made a lot of money, and it was followed by the infra boom, that all the capital goods, power companies, infra companies made a lot of money, and then they peaked out. And in 2015, it was pharma's turn, all the pharmaceutical companies. In 2019, it was financials. And again, in 2021, it was IT all over again. So markets work in cycles. And where are we currently? Right. So in the previous webinar, we had discussed each of these columns one by one. Today's focus will be on the top right column cell, that is financial services. As of March 2023 closing, they had a weight of 38% in the Nifty 50 index. Right now, the weight has come down a bit. It's close to 36, 37%. But why is it so high? Will it continue to be there going forward? If yes, for how many years will that be as high as 30, 35%? Let's dive in. So before we look at India specifically, we should look at how the global markets have evolved over time. And the best market to look at would be USA, because that's the biggest and the largest market in the world. So USA's leading index is called the S&P 500, similar to our Nifty 50 in India. And this is how the weights of each of those sectors have changed over the last 40, 42 years, right? So they were very energy heavy to begin with, but then the financials started having a larger share of the pie. They went from 5% to almost 20% at the peak of the 2007 infra bull cycle, right? And then they've tapered off. That's because of the growth of the other segment that you see here, which is IT, right? This is not our Indian IT. This is your product IT. All the fangs of the world came in, and Nasdaq started growing, rising exponentially. And in terms of numbers, like we said, so financials went from 5% and they peaked at 21%. And it's not like the other sectors didn't grow at all. So all of them grew in absolute terms, just that the weight declined because of the rise of IT. From 6%, IT currently has a share of 28% in S&P 500. So that's how the sectoral weights have changed in US. So the big reason for the rise of financials from 5% to almost 20, 21% is the primary driver is the household debt to GDP percent, because the correlation is high. So we look at this metric alone. And on the left, you can see that the household debt, like say you will take all the households in the US and accumulate their debt and then compare it with the US, the entire GDP. So that ratio went from 30, 40, 45% to almost 100% at the peak of the 2007-8 bull cycle. And after that, that was the peak. It never went back there again. It's now below 80%. If you overlay this graph on the graph on the right side, it'll be the correlation will be very high, because that's what was driving the banks and the financials weight in the sector. As and when the household debt to GDP peaked, the financials weight also peaked, right? And even today, the financial sector weight is lower than this. This is a bit dated. So today it's at close to 13%. So this is what happened in the US. And if we look at specific banks, let's say JP Morgan is the largest bank there, and they had struggled to grow their assets in the last decade, that is between 2012 to 2022. If you look at their growth rates at the bottom of the table, 2 years it was decent, but if you look at the rest of the years, it's low single digits, right? There was no growth at all in US banks. Only post COVID, because of all the government subsidies and the government giving money to people, the assets of the banks in the US rose. And this is in terms of growth. In terms of ROE, post the bull market of 2007, the banks struggled to make double-digit ROE, except for JP Morgan, which is the largest bank. I've taken two more, Bank of America and Bank of New York Mellon. There are hundreds and hundreds of banks in US. Except for JP Morgan, none of them made significant money in the US because the ROE never touched double digits again until COVID hit and the government gave money to people just like that, right? So both growth and ROE took a hit for US banks, and it was kind of a double whammy for US banks because the underperformance of US banks in business terms coincided with the rise of FANG and Nasdaq. So on one side you have banks underperforming, on the other side you have the likes of Amazon, Facebook, Apple, Alphabet, that is Google, and all of them doing really good, growing exponentially year on year, right? So it was kind of a double whammy for US banks, and that's kind of reflected in the price CAGRs or the returns that these stocks have given. Except for JP Morgan, which has done decently, the rest of the banks haven't given any shareholder returns in the last 15, 18 years. It should be lower than US inflation of 2%. So where is India in terms of the metric that we were talking about, household debt to GDP? Right. So if you look at this graph, it'll look volatile to you, but that's because the range is very narrow. So we've been trending between 32 to 44 kind of percent. And we saw a decline in the last decade between 2011, 12 to 2017, 18. But we are seeing a rise again in household debt to GDP. And how do we fare compared to all the global countries? Right. So India is somewhere towards the right of the graph. You can see India along with some other emerging countries. But if you look at all the developed countries, which are on the far left, right, US, Switzerland, all of those countries, they're all significantly higher than India's household debt to GDP. In fact, I would say 2x of India's household debt to GDP ratio. So we are nowhere close to the peak in terms of this metric. And this is what gives us confidence that we still have room for banks to grow. And so there was a recent study conducted by a few professors, and the study states that so they studied 54 countries globally between 1990 to 2015, and their results suggest that there's a negative long-term effect of this household debt to GDP ratio going up. So if it exceeds 60%, the consumption there's an impact on consumption, and if it exceeds 80%, there's an impact on the GDP growth itself. Right? This is what we saw in US. The household debt to GDP peaked at 100%. It's now fallen to the 80% levels. So how much does India save or borrow every year? So we have been consistently saving more than our loans or the liabilities. So if you see GFS is gross financial savings. So we've been saving 30 lakh crore in FY23, and our liabilities in FY23 were close to 16 lakh crore. But what has changed suddenly? Right, in FY23, we have borrowed much more than we have managed to save. If you see, from the pre-COVID levels of 7.7 lakh crores of financial liabilities, our liabilities have jumped almost 2x just in a space of 3 years. So is there a new behavioral trend emerging that where we are borrowing more than we are saving or that we used to save before? So this is a very emerging trend, and this data just came out last week. So we'll have to keep checking this, monitoring this trend as to how it evolves over the next few years, as to see if India's household debt to GDP, is it a structural uptrend or is it mean reverting in a small range that we've seen in the last decade? So this will, whenever this ratio goes up, banks will benefit because they lend to all our households. So there are two levers to bank growth. One is what we saw right now, which is household debt to GDP. Then there is corporate debt to GDP. What your institutions, industries, companies, MSMEs, how much are they borrowing compared to our GDP? Again, even in this metric, you will see India to the far right, at India is at 51% corporate debt to GDP, whereas the emerging markets, they're all at some are even above 100%, and some are close to 100%. China is above almost at 130%, because in the last cycle, all their corporates and the state-owned entities, they borrowed to put up infra between 2000 to 2010, and that's how they shot up to above 100%. I've also colored Brazil and Indonesia. Just so post this webinar, you can go to Brazil's index or even Indonesia's index to see how much financials weight is there in their major index. So the ratio for Brazil and Indonesia both is above 20%. I think Indonesia has a higher financials weight than even India. It's somewhere close to 40-50%, which means we are still very underlevered. In relative terms, we are levered, but compared to other emerging markets or the developed markets, our corporates are significantly underlevered, and that gives rooms for banks to grow. So this is the credit growth of India. The green line is the overall Indian credit growth. And if you see the previous, in the beginning, in the first slide, we spoke about market cycles. 2000 to 2007 was the infra boom. And that's when credit growth grew exponentially. In fact, at the peak of the cycle, just before the peak, in March 2006, India's credit grew by 35 to 40%. I don't think we'll see those high rates again because our scale has gone up. India as a country has grown much bigger compared to that time period. But when the next Capex cycle picks up, we'll see significant credit growth, say in the range of 15 to 20% at least. Right now, the black line, which is the industry credit growth, that is the corporate credit growth, it's very muted. It's less than 10%. That's because, again, market cycles. So between 2000 to 2007, companies made a lot of money. They invested that money and they borrowed money further to put up Capex between 2007 to 13. And now they're generating ROE on those assets that they put up 10 years ago, right? So they're making cash flows now. So they don't necessarily need credit to grow further. So they're using their own internal accruals, internal cash flows to grow. But this has to change at some point, and that's how markets and cycles work. So when the corporates start borrowing again, the credit growth will pick up again, and banks will again benefit from that. So if you look at our India's corporate debt as a percentage of GDP, like I said, we were putting a lot of Capex in the last cycle up until 2013. That's when our corporate debt to GDP ratio peaked, and now we are back to 50%. So we are where we were in 2007 or 8 kind of periods. Sorry. So corporates will re-leverage their balance sheet in the current or the upcoming Capex cycle, and that's when the industry credit will also grow. So we have seen the two levers: household debt as a GDP and corporate debt as a GDP. We are nowhere close to the global averages. In fact, we are significantly underlevered compared to relatively to other global peers. That gives room for banks to keep growing at whatever rate they're growing. Right. So we spoke about banks. So can other financial services gain market capitalization share from banks? Again, so we'll go back to US. So this is in percentage terms on the left and on the right in absolute terms. So the share of banks, which is this light pink color, it peaked in 1997 when it was flat or plateaued till the 2007 peak, and then has been declining. But in absolute terms, banks are still at their all-time high market cap, which means that the other financial services, which is your AMC, it could be your payments, they've been growing faster than banks, right? You see this pink color on the top, that's payments. Payments were not there before 2007. It picked up post 2007. Your American Express, Visa, MasterCards, all the credit card related stuff, anywhere, any transaction, you'll have to pay these companies a small margin, right? That's when this set of companies started picking up, and then the growth of AMCs also overshadowed banks' growth. It's not like banks didn't grow; they were growing, just that other financial services grew faster than banks. So what about India? We feel that India is different. We look at each of those reasons. If you see this graph on the right, in absolute terms, every piece on its own is growing, right? PSB banks are growing, private banks are growing, and then there is a new segment of banking, which is your small finance banks, NBFCs are growing. So we are not seeing any kind of plateau in any of these sectors, and that's one. And two, so India is different because there's no money in payments, right? We saw the MasterCards and Visas are growing in the last 10, 15 years in the US, but that can't happen in India. One, because we do pay some to MasterCards and Visa when you make your credit card payments, but they're all listed in the US. So it will not go through your Indian listed entities. But now UPI is growing and it's becoming bigger than your credit card payments and any other modes of payments. But UPI is free. RBI has kept it free. We don't know for how long they'll keep it free. So there's no payments as a business model in India, and that's why you will not see what happened in US happening in India. And this is a commentary from Bajaj Finance, one of the best in the industry. So they acknowledge that there's not that much of value as in profit pool available only in payments. So if you want to do only payments, there's no business model. You'll run out of your money, you'll burn cash, and then you'll go out of business. But you need payment because you get the data, who's buying what, who's sending money to whom, and all that. You'll get that data, and you can cross sell other financial products or banking products to those payment customers, right? That's the business model. You can't make money from payments. You'll have to sell something else through payments to make money. So this is the broad profit pool of the entire banking sector in India. You could see that almost 75%, which is 3/4 of the pie, is from lending income. And RBI so far hasn't given any banking license to any fintech, unlike other countries, say US and Australia, where fintechs have got banking license and they've started operations competing with the likes of JP Morgan. But that's not happened in India yet because RBI is not comfortable giving out banking license to these fintechs. But fintechs can get the NBFC license and they can try to grab a piece of this lending. NII is net interest income, so they can grab a piece of this. But within that, if you look at the profit pools, if you double click on this lending NII, it'll again be consisting of corporate loans, MSME loans, retail loans. Retail loans will be 1/3 of this lending NII, which means, and within that lending NII, retail NII, you'll have housing loans, you'll have personal loans, you'll have credit cards, you'll have vehicle loans. Fintechs might not do any of those secured loans. So fintechs immediate low hanging fruit, if you were to say, would be your personal loans. That as a category is very small compared to the overall lending pie. Right. And if you look at the other piece, so fintechs can't give out credit cards. They'll have to partner with banks who can give out credit cards. Again, beneficial to banks. Deposit fees. Fintechs cannot collect deposits unless you have your banking license. So fintechs can't attack this piece. Debit card fees. Again, no fintech can give out debit cards. AMC fees and insurance fees is the other share where fintechs can attack or try to gain market share. So banks distribute financial products. If you go to their branches or even other, they'll call you up to asking you to buy this mutual fund or this endowment policy. So they'll get commission when they sell these products, right? AMC and fees and insurance fees. Fintechs can do that. So they'll build a payment model, business model, and once they onboard you, they'll start cross-selling you insurance products and mutual fund products. So on the overall profit pool of the entire banking sector, only very small, that is personal loans, and within that, say, credit cards and AMC fees and insurance fees is where fintechs can target. And even that will be very difficult. We'll see why. Sorry. So the fintechs in the financial tech companies or startups, say your Paytms, PB Fintech, Grow, PhonePe, they do not manufacture any product, lending product or liability product or AMC or insurance. They only distribute all of these products that I mentioned, which means they don't compete directly with banks. They'll only expand the market and help the banks to grow, which is good for banks, right? And the credit card piece that we are talking about, fintechs are not allowed to distribute credit cards, but they brought in something called as BNPL, buy now pay later. And if you guys have used Paytm postpaid or even say Amazon's buy now pay later, you'll think that Amazon is lending. But underneath, there's a funny thing that Karur Vysya Bank had to clarify on Twitter that your actual Amazon buy now pay later is actually being funded by Karur Vysya Bank, right? So you're indirectly borrowing from Karur Vysya Bank. Amazon is just a front end because they don't have an NBFC license. They wouldn't want to do it. Even Google Pay wouldn't want to do it. But even say Paytm postpaid, that's being funded by Aditya Birla Capital, which is an NBFC, or even ideated First, which is a bank. So even the profit pools that they're targeting, fintechs are just merely being distributors for these products. They are indirectly helping banks to grow by expanding the market. And there's been a lot of focus on OCEN, Open Credit Enabled Network. But if you drill down and see what OCEN is really about, it's basically you will be able to auction your cash flows. Let's say now we are moving from secured lending to cash flow based lending, where banks and fintechs will measure your cash flow ability and your repayment ability, and they'll give you loans based on your cash flows. But based on this, uh, if you go to Policy Bazaar and check, say you search for a loan, you will obviously choose the loan that has the lowest interest rate, right? So how can companies have low interest rate? That's where the power of liability franchise comes in, and that's where the power of a banking license comes in. Fintechs can't borrow deposits, which means they'll have to borrow from banks, borrow from NBFCs, which means they'll have higher cost of funds. So they can't lend to me or you at a personal loan at 12 to 14%. They'll have to lend at 16 to 18%, which is going down the quality curve. Their uh, recovering the money will be difficult, credit costs will be higher. So banking license is like a time bomb until RBI starts giving out banking license to fintechs. I don't see that happening going by the commentary by RBI governors in various platforms, and which means banks will continue to have all the market share, and they'll benefit from all this fintech events that are happening. All these, the Paytms, Grows, Phone Pays, they'll all only help banks grow by expanding the market. Even otherwise, in terms of the absolute market itself, we just crossed our teenage. We are entering our adulthood. So we are young adults in terms of financialization. So why do I say that? If you look at our mutual fund assets, all the mutual funds put together, the AUM currently is 46 lakh crores, and that has grown multifold in the last 20 years if you compare with 2003. But even after this, our mutual fund AUM as a percentage of GDP is at only 16%, whereas the world average is at 70%. And that's seen across all the financialization metrics, be it demat accounts. So we are at 11.4 crore demat accounts, and these are multiple accounts. I mean, every user can have different demat accounts, right? But let's say this is the average. Our equity penetration is just 7.5% because our population is 140 crores, but the world average is 70%, right? So what these fintechs will enable is they'll increase the number of demat accounts, they'll increase the number of mutual fund assets, they'll help people move their savings from, say, buying a property, they'll enable people to buy mutual fund assets or insurance, right? Even in terms of life insurance premium, our life insurance density, that is the share, the premium or the coverage that each person gets in India is just $70 put together on an average. Even if we don't have to compare with the global averages, even if we compare with our emerging market peers, which is China and Thailand, we still have room to grow 4x the life insurance premiums in the country. All right. So that's why we feel that India is different from US. And now drilling down, double clicking on the AMC piece. So this graph, I keep wondering how can this happen, because we are used to linear growth, step by step, incremental 10%, 15% growth year on year. But if you look at the period between 1980 to 2008, the mutual fund assets to GDP ratio was growing exponentially, right? And that can happen in India because of whatever we've been talking about, the fintechs distributing more and people spending more or borrowing more, right? And the best part is the top two AMCs in the US, BlackRock and Vanguard, they're not banks, but that's not the case in India. all the leading AMCs are owned by banks themselves. So banks own everything that has got to do with financialization. So HDFC, SBI, ICICI, Axis, Kotak, all own leading AMCs of the country. Maybe say the likes of Nippon, DSP, PPFAs can gain market share, and there are some fintech startups also in this space. Zerodha has moved from broking to they've got their mutual fund license now. Navi has been operating in the space, but they are not able to scale up, right? So now Geo is talking about entering the space, but we'll have to see how much can Navi and Zerodha can scale up and how much they can compete with existing incumbent players like the bank sponsored AMCs. Not just AMC, even in insurance, it's different in India and US. In the top insurers in US, be it Berkshire Hathaway, which is Warren Buffett company, AIG, Progressive, MetLife, Prudential, they are not owned by banks. But all leading insurance companies in India are owned by banks. So banks own everything again. But there are some standalone insurance companies like Star Health and our own LIC, and there are some fintech startups in this space, Raco and GoDigit. GoDigit General is a pure general insurance is a pure startup, but GoDigit Life Insurance, if you look at the shareholding, now all the top banks have got 10% stake in GoDigit's life insurance, right? So again, the underlying is being owned by banks. And another interesting thing is the TAM for insurance is the sky is limit. TAM as in total addressable market. Let's say today I come to you and tell you if you have a cover of 10 lakhs health insurance, I'll tell you that medical inflation has gone up so much, 10 lakhs cover isn't enough for you. You'll have to take a 50 lakhs cover. And insurance being a sensitive topic, I can just by convincing you, I can increase my TAM from 10 lakhs to 50 lakhs just like that, right? So there's no limit for the total addressable market of insurance. So that's how that's the huge opportunity sitting in insurance, and all of that is again majorly owned by banks in India. Banks own everything. So where could the risk come from the bank's weight or the financials weight? It could be banks' own underperformance that we saw in US. So credit growth slowing down from the current. So today, India's credit growth is around 15% year on year. Let's say that comes down to single digits. So that will so the bank's weight in the sector will take a hit. And corporates currently they're using their own internal cash flow for putting up capex. But for how long can this happen? In the previous cycle, 2002 to 2004, we saw this happen. Companies were using their own cash to put up capex, but beyond 2007, every company looking at the profits that other companies were making started putting up capex by borrowing money. So that will happen. It's not a case of if, it'll just a matter of time, right? And what if household debt as a percentage of GDP remains range bound that we have seen in the last decade? What if it doesn't move up to say the levels of China at 60%? Again, that's a risk. Okay. And quantitative easing or excess liquidity in the market driven by RBI or by FI will mean that there'll be other sources of borrowing. Say companies can go to the bond market to borrow instead of banks, or there'll be new exotic products like REITs and InvITs where companies can go borrow from instead of the traditional banking channel. Maybe that's a risk. But all of these are very minute because India cannot grow without credit growing. So we looked at US. We'll have a look at China as well, the second largest economy, right? So we have very limited data because China doesn't give out data. This is data of MSCI, private index managing company, right? So the financials from 2008 to 2019, up until 2019, have declined slightly, say from 25%. Now it's come down to 20 kind of percentage. That's because of the rise of these two columns that you see, communication services and information technology. Again, what happened in US, that is the FANGs, Facebook, Apple, Alphabet, and so on also happened in China, which is your Tencent, your Alibaba, your JD.com. So they completely changed the index structure, and that's why the weight of financials had to come down, right? And there were also a few other reasons. Okay, between 2000 to 2010, China was your traditional, typical old economy. Like government was spending, they were putting up infra, capex in every sector possible. But sometime towards the last decade, China started moving towards a consumption-driven economy. That's why in the previous graph you'll see this gray piece of the graph growing exponentially in the last few years. That's consumer discretionary, where you'll be buying cars, consumer durables, vehicles, and so hard assets, right? And even if you look at real estate, which is again discretionary, it wasn't present in the index at all before 2015. Only after 2015, it started taking a piece of the overall share. So the reason for real estate and consumer discretionary growing was driven by the higher per capita income of China, right? And this is the per capita income comparing China and India. We are where China was in 2007-8 period, right? So we still have a long way to go for our consumer discretionary to pick up. That's one. Two, will our manufacturing grow faster, right? Let's say, there's a lot of talk about Make in India, not just for India, even for the world. So if you look at all the manufacturing companies within Nifty 50, you'll see the likes of L&T, Hindalco, Tata Steel, JSW Steel. Can they grow at the rates that banks are growing? And all of these are capex heavy companies. Unlike in China, where there are state-owned banks, uh, we also have large private banks in India. So if these companies have to grow, they'll have to borrow and grow, and which is again beneficial for banks. And let's say we look at the Nifty Next 50, which is the companies from 51 to 100 of the top companies in India. You'll have ABB, Siemens, Havells. Can they grow as large as the banks today are? I doubt so. It will be very difficult for them to match the growth rates of banks consistently. Like they might grow faster for 3, 4, 5 years, but if you look at the past record, post 2007-8, the growth for these companies completely went away, right? So they don't have the ability to keep growing at the rates that banks are doing. And mid caps, I mean, they're already pricing in few years of growth. So we have seen both in US and China, IT becoming really big and cutting out the weights of all the other sectors. Can that happen in India? It can to some extent, where India can continue to import global wage inflation, right? Wages going up in US, which means there'll be more work for Indian IT employees. So that can happen, but we are not apples to apples. Our Indian IT is not the same as US IT, which is more product oriented, right? So we don't have our own social media, right? We try to do something with Coup that became a failure. You continue to use all the US products, but China had its own communication services similar to WhatsApp. They had their own e-commerce. So again, this is not what happened in US and China cannot happen in India, at least to some extent, because we don't have product oriented IT companies. Consumption, DMart, Titan, Reliance Retail, they're all very small in terms of their market share compared to the overall retail market in India. So they can go up in the long term. Consumer discretionary and real estate, today we have only one company. We don't have any real estate company in Nifty 50. We have one DLF in Nifty Next 50. In mid caps, we have Oberoi and your Godrej Properties. So it will take a long. We'll have to have a 10-year real estate cycle for these companies to become as big as banks today, right? So, but yeah, so in the long run, when our per capita income matches with that of China, there's a possibility of real estate having a higher share going forward. So this is what I was talking about. On the right, you'll see the graph between, on the x-axis, you'll have credit growth. On the y-axis, you'll have the capital formation. So whenever gross fixed capital formation has grown at high digits, that is, whenever people have been putting up money in hard assets, be it industries, be it your corporates or any manufacturing related or even service. So whenever that has grown at a faster rate, credit has also grown at a faster rate, which means there's a high correlation between capex cycle and credit growth. If cap India has to grow, if India has to manufacture for India and for the world, credit we need credit, right? But credit can come in three forms. One is banks, one is bonds, the third is equity. Even if we say that banks will fund one third of the capex cycle of India, that's still good growth for banks to keep growing whatever rates they're growing, right? So R square here is nothing but how much of Y is being explained by X. So credit growth is able to influence 75% of capital fixed capital formation in India. So other sector performance. So what can be the Apple or the Fang or Tencent or the Alibaba of India be? Right? We already have Amazon, we already have Google in India, but they're all listed in abroad. So there could be other companies like Flipkart, which is very big. They're talking about huge valuation, almost 5 lakh, 10 lakh crore valuation, but they are also saying that they'll not list in India. They'll list in other global markets. It could be Nasdaq, right? And the regulator is forcing Tata Sons to list. Today's value is roughly 11 lakh crores, but it will go up in the next 2-3 years by the time they list. So that can get a big share of the index if it lists, and based on what kind of ownership. Ownership matters because, like in IT, we prefer other companies, but Infosys has the highest weight because of they have high float. Their promoters own only 15% of Infosys. Everything else is owned by public. So because of the high float, they have higher weight in the index. So ownership matters. And there are other startups in India that can become really big. So some are already listed, and few others can come for listing. Again, the risk of where they list, because Freshworks didn't list in India, they listed in US. Flipkart, again, like I said, can list abroad. Byju's, Oyo, Ola, Dream11, Swiggy. So they can get a small piece of the overall sectoral weight going forward. But this is really long term because they're all very small. All of them are valued at less than 1 lakh crore. Maybe say Razorpay, PhonePe. I think they're the largest valued, close to $12 billion, right? But it'll take a long time. So another thing is not just the ownership, the growth rates. So Amazon, Flipkart in India have kind of plateaued in terms of growth. They're not any longer growing at fast rates. So they'll have to grow at least 15% or more than 18% to bring down the weight of financials. So which brings us to HDFC Bank. We call it the TRUBLU champ because it's a top weight in our portfolio, in TRUBLU portfolio. It's an execution machine. It's a machinery, well-oiled machinery, because the bank doubles every 4 years. In CAGR term, that's roughly 18%. So they've been growing doubling every 4 years for the last 10, 15 years. And that hasn't gone down at all. It's slightly gone down. Some say they were growing 2.4x March 13, and that's now come down to 2x in 2023. But they continue to double every 4 years. So any company which wants to bring down the share of financials will have to grow at such rates consistently to bring down the weight. Only startups can do that because of the asset light model, but they're all very small right now. Another interesting point is, of course, this is a function of scale, right? For example, the entire earnings of HDFC Bank in FY 2016, they matched it in just 1 quarter in 2023. So the 1 quarter earnings is equal to full year earnings in roughly 7 years, which means they're doubling every 4 years, roughly. So in the last 10 years, the book value, the intrinsic value of HDFC Bank has grown at a CAGR of 21% year on year, and the share price has grown at 17%. If a company is growing at such high rates, and if it can, we are seeing the evidence that it can keep doing it year on year, at least for the next 5, 7, 8 years, why should we preempt something like, say, the weight of HDFC Bank will go down, they'll underperform? So what they're going through right now is temporary because of the merger issues that will be sorted out in the next 2, 3, 4, worst case 4 quarters. And but the underlying business will continue to grow. The multiples might take a hit, the price to book multiples, but the underlying business will continue to grow. They've shown it in the past. They are showing it currently. We believe that they'll continue to show it in the next long term, 5, 7 years. So, what drives the valuation of banks? It's all down to one single metric, that is ROA, return on assets. Right? So, if HDFC Bank is lending me 100 rupees, they'll earn 2%, 2 rupees on the loan that they give me. So, that's what is meant by ROA, return on assets. And if you look at all the large private banks, they're all close to this figure of 2% ROA. So ROA alone as a standalone doesn't drive completely the profitability, the valuation, but consistent ROA across time periods is what matters to get a high price to book multiple. And HDFC Bank has shown that in the last, in its entire history, I would say, right? So it hasn't gone down like say a PSU Bank or the other, the tier two smaller private banks. So they've showed consistency, both HDFC Bank and even Kotak Bank. Now, ICICI and Axis might show that going forward. So that brings us to the ithought way, our investment philosophy. So we have a very long-term focus. We don't look at 1 year, 2 year kind of trades. We are all very long-term focused, and we do non-consensus investing. If a sector is off trend, if everybody is making threads on Twitter, we don't have. If we are already there in that, we would be looking to exit. We'll not be looking to buy. So we look at contrarian ideas, not just for the sake of contrarian, but for the sake of better multiples and long-term focus. And we'll have a bottom-up approach. We'll not look at what the index is doing. We'll give merit for the company and where that company is in its market cycle or the business cycle. High focus on risk management. We don't take a lot of leverage. And so the TRUBLU portfolios are large cap portfolio. We try to capture the mega trends. One is the India growth story that we have been talking about, and then the global champions, let's say our IT companies, where they're helping other countries grow. So the USP of TRUBLU is that we are a 100% pure large cap PMS product. We have very high active share. We'll have low churn. We don't buy and sell. We try to have a buy and hold strategy unless something significantly changes in the company. And the product also has zero fixed fees. It's all variable. Like I said, we have only 20 stocks in the portfolio at an aggregate level. Client level, it could be even some could have 15 stocks, 13, 12 stocks. So, like I said, we have very high active share, and that's why we have low number of stocks. If you look at all the large cap mutual funds in the market, they'll all try to hug the index. They'll be try to replicate the index as much as possible. Right. So all of them look at the number of stocks that they have in their funds. So active investing is what is our forte. If you compare TRUBLU with Nifty 50, the large cap index, our top 5 stocks have same or similar weight as Nifty. Our top 10 stocks have higher weight than Nifty. But if you look at our bottom 5 and bottom 10 stocks, we have significantly higher weight because of our concentration, because of our higher active share. We have much higher allocations compared to the Nifty 50. And even within the top 5, top 10, you will see it's completely different. I mean, the top 10 stocks in Nifty 50 doesn't have Bajaj Auto, which is a consumer discretionary play. It doesn't have HDFC Life Insurance in the top 10. It doesn't have HCL Technologies, but it has Infosys because of the higher flow that we spoke about. Right? HCL Technologies majority promoter owned, the Nada family. That doesn't mean they should have lower weight in the index. So, but we can afford to have higher weight in HCL, and even Maruti Suzuki, which is a better consumer discretionary play. It doesn't find a place in the top 10 of Nifty 50. That's how our active share works. And in terms of drawdowns, right? In the last 3 years since our product we launched the product, there have been 2 drawdown periods, significant drawdown periods. One was the low was June 2022. Where our drawdown, the TRUBLU's drawdown was only 12%. Every other large cap fund had a higher drawdown compared to us. Even the Nifty 50 had a drawdown of 17%. And all other large cap mutual funds also had a higher drawdown than our product. Not just this particular period, but the next period was March of this year, March 2023, where Nifty 50 fell 10% over a course of time, but TRUBLU fell only 5%. And this is almost half the drawdown of the index itself. Of course, compared to other funds, we have, we've fallen lesser than other mutual funds also. This is where our bottoms-up approach, our long-term focus, and our non-consensus investing is reflecting. So our endeavor is to have a performance of say 200 to 300 bips, 2 to 3% over and above the Nifty 50 over a time period of say 3 years, 3-year rolling. We endeavor to outperform the Nifty 50 index by 2 to 3%. So the product's suitability, and if you're a first-time investor, if you're new to the markets, you should definitely explore TRUBLU. And if you're close to retirement, if you're already retired, you'll need a high-quality blue chip portfolio for your retirement corpus. Or if you're from a family office, or if you're an institutional investor where you have mandates, you have to manage your treasury, TRUBLU is the best product for you. So TRUBLU should be part of your core wealth creation portfolio, resilient in terms of the drawdowns, which we just saw, high quality in terms of the largest of large high ROE companies in India. The fact sheet, so currently our AUM is 36 crores, and it's, like I said, it's a large cap fund. We've allocated 90.5% and we are holding 9.5% as cash. Another interesting metric is beta. Again, we've already seen it in the drawdowns, but another metric to measure the kind of risk that we take compared to the index, the beta, our beta is 0.73, which means we're taking 27% lower risk compared to the index itself. Our founder and fund manager, Mr. Shyam Shekhar, he is managing the fund, and the co-fund manager, Mr. G.R. Balaji. And this is our complete team. We have 4 products. TRUBLU is what we spoke about today, which is our large cap product. Solitaire is a multi-cap product. Vriddhi is a small cap and micro cap product. Spear is multi-asset product. And our strong research team, almost a 10-member research team and 4 fund managers. So this is our performance. I mean, proof of the pudding is in the performance. And in the year time period that we track, which is 1 year and 2 year, we have outperformed Nifty 50 by a significant margin. In 1 year, we have done 14.7 compared to 9.5. That's a 5% alpha over the index. And in the 2-year period, we have outperformed by 2.5% over and above the Nifty 50 index, right? And our September performance even better than this. This is as per SEBI records we have captured till August. Key terms: 50 lakhs is the minimum investment as mandated by SEBI for any PMS product, not just TRUBLU. Nifty 50 is the benchmark, and we have both options of fixed fee and variable fee. I think that's it from my side, and we can take questions. You can drop your questions in the chat box. I'll be happy to answer them. Thank you. On the top, you'll see chat option at the top of the window. You can click on that and start typing in your questions, if any. So we have first question. So any commentary on HDFC management? So there's been a change in the management after Aditya Puri held the firm for almost 25 years. We've moved on to Shashi and Srini now. We've been interacting with them through the course. We've been listening to them in the phone calls and the other events that we've been participating. So we find them to be very focused. They know what they're doing. They were wrong in their technology abilities. They didn't match the tech stack of all the other fintechs, which they've rectified now. And they're going through a huge merger, one of the largest in India. right? So that merger and the management transition and the tech transition has resulted in the underperformance of HDFC Bank vis-a-vis other banks. So that will take some time, and even the merger, they had a call recently where they stated that next 2 to 3 quarters is what they need to digest the merger or to go back to the previous pre-merger numbers. So that's explaining the underperformance of HDFC Bank. But we are not thinking short term, we are thinking long term. If they can continue to grow at 18%, why would I chase another company expecting it to grow faster than HDFC Bank? In India, are people still getting loans from unorganized lenders? Of course. So if you look at the MSME space, we'll forget the Ashari or the chit funds that we as individuals borrow. But even if you look at the industry setup, which is MSME, 25 lakh crores the overall MSME loan book. All right. Of that, only 10 lakh crores is by NBFCs and banks and other organized financial institutions. Rest of the 15 lakh crores, all the companies are borrowing from your local money lenders. So people are still borrowing, and they're borrowing at much higher rates, say 20%. You will call it in Tamil, we call it rendu vatti, moonu vatti, which means 24%, 36% interest rates, right? That will change to some extent because of OCN, because of cash flow based lending, and so on. Any effects on global bond market inclusion? Corporate can easily access capital through global route. Right now, the bond inclusion is for the Indian government bonds. So some of it, let's say the foreign funds come in for the government bonds, and the existing investors who have invested in those government bonds will have other avenues to invest. Of course, that will help corporates to borrow. Again, that's all linked to interest rates. In a rising interest rate environment, the bond market captures the higher interest rates first. So corporates will look to move to banks. In a decreasing interest rate environment, bond market tends to price it in faster. So corporates will go back to bond market to borrow. Again, so there are various avenues, even equity included. So corporates can borrow from anywhere. So that's a risk. And the global bond market inclusion is positive overall. So only one index has added India. People are expecting other indices to follow suit. So we'll have more and more inflows, foreign inflows coming to in the Indian bond market. What is your view on PSU banks? Is it time to take the profit or we can hold? The hot topic of late in WhatsApp groups and Twitter. Prime Minister Modi ji signaled asked investors to buy PSUs, and they've been going up ever since. So our view is that if you had a broad-based PSU basket 1 year ago or 2 years ago, that period is gone. You have made your money. Right now, you'll have to be very stock specific within PSU itself. Right. So all the PSUs currently, their historical peaks have been 1% ROA, and SBI, Bank of Baroda, they're already there. The others are way behind. They're at 0.7 ROA, 0.4 ROA. So we still see that the economic recovery that is happening can continue for FY24, FY25, post which they'll have to struggle increasing their ROA beyond 1%. Right. So the re-rating has already happened. From now on, you'll have to be stock specific and see which PSU bank does it have a low cost of funds compared to private banks, and can they increase their ROAs from the current 1% to 1.2, 1.3%? Because so in the subsequent TRUBLU webinar, we'll also be looking at ROE tree and how to value banks, where I'll explain in detail. But you'll have to be very stock specific going forward. You can't hold the entire basket of PSU banks going forward. Has there been a cultural change in the lending practices of PSU banks since the last cleanup? These are very early stages, sir. So whatever cleanup, if they claim to have done it, is not reflecting in the current credit cost, because lending works in cycles. I mean, if it's a 1 year, 2 year loan, like personal loans, it'll be immediately reflected in numbers. But corporate loans are long-term in nature. It'll take at least 5-7 years vintage, what they call it, vintage, right? You'll have to go through the first 5-7 years for bad loans to creep up, credit costs to be impacted. So these are very early days. But from what we are hearing, some PSU banks have changed it, be it SBI, be it Bank of Baroda. So they've done some works, and there is some consistency, not just in PSU banks, even the lower tier private banks. But if you see, if you follow RBI governor's statements, he's saying that in one of the speeches, he said that PSU banks are not, he didn't mention PSU, he just said that some smaller banks are evergreening their loans, as in they are giving fresh loans against the previous loans for the borrower to stay, not default, right? So that's a bad thing. So he said that there are some red flags and he called it out, which is slightly negative in terms of sentiment. We don't know, we're not sure of what banks these are, but if you go down the curve, if you go down to the tier 2, tier 3 banks, so there'll be some red flags. So we want to stick to the large banks. Which one would be better, S&P 500 or Nasdaq index for long-term investing? Sir, at current prices, I wouldn't suggest both. So we haven't. So we have a multi-asset PMS product, which is Peer, where we do invest in international global funds. So they'll be the right person. But even otherwise, at current prices, we don't see merit in switching to US funds or any other market for the matter. When we have the evidence that India itself can continue to grow. So far, the Indian consumer mentality has been one of saving. We have just begun investing. Seeking of credit for consumption will hurt the way Indians deal with money. Very few have required the risk appetite. Is credit growth the only way for growth of wealth in the Indian households? So credit growth isn't the only way. So we can take the example of China because that's more recent than what US. So what happened in China was the government spent. Second, the corporate spent. As a result of both these expenditures, the income levels of people started going up. The per capita income started going up. So only after a point, they started buying homes, they started buying consumer durables, they started buying vehicles. Right? That's why you see the impact of real estate, consumer discretionary going up in China's overall weight. So of course, credit growth alone isn't the only way, and it's also up to the banks to create that mentality of paying back, repaying, because personal loans can balloon up and cause the entire banking sector to fall, like we saw in the global financial crisis of 2007, where people were borrowing left, right, and center to buy homes, and that resulted in a real estate bubble in US. Of course, that's also a negative factor, but we have to increase our income levels. We'll have to bring in more people onto the workforce. We'll have to bring our women to the workforce, right? That will increase the income of the household. So once the household has multiple sources of income, they can borrow against it. So their debt to equity at the household level will be manageable. So what's the bear case? Please, for HDFC Bank, Kotak Bank, multiples compressed to half of current multiples. So like I said, we'll discuss ROE and valuation in the subsequent TRUBLU webinars. But for now, I'll give you this thumb rule, right? So let's say that HDFC Bank and Kotak Bank's ROE 16%, right? You subtract the cost of capital. Let's say for Indian banks, the cost of capital is 8, 9, 10%, 10% worst case. So you have a room of economic value addition of 6% that banks have because of lower cost of capital. They'll borrow at 8%, then they'll lend at 16%. It's a rough understanding of this ROE, right? So, and you divide it by 2. That's the thumb rule. You divide ROE minus cost of capital by 2. That'll give you the price to book multiple, right? So let's say 12% is the cost of capital, and HDFC Bank's ROE is 16%. So 4 by 2. I mean, HDFC Bank can trade at 2x price to book. You never know with markets, because at the extremes, market goes below what is fair value, it'll go to undervalued. In some sectors, not necessarily banking, it'll even trade at bankruptcy valuation. So you'll never know with the market. You'll have to be dynamic and keep adjusting to the situation. Account aggregators and small ticket lending, how is the advantages? Or would the fintechs gradually take over and commoditize retail loans? Okay. All right. So I've spoken about this. Let's say I want a loan. I'll sign up with an account aggregator. I'll give my cash flows. I'll ask them to take my bank statements. I'll give them my salary slips if needed, or whatever data that let them take whatever they want. They'll take my broker's financial asset statement, and then I'll be able. It's like a marketplace. I'll be able to see which bank is offering me a rate, interest loan at what interest rate. Why would I choose someone, say, a fintech, which will give me a 12-14%, which is what credit is trying to. Now they're partnering with IDFC First, and they're trying to give personal loans at 12-13%. But a HDFC Bank can give me a personal loan at say 10-11% because they have deposits through their banking license. So I'll be able to auction my cash flows, right? I mean, I'll say bank, whoever is giving me the lowest interest rates, I'll take the loan from. So the interest rates decides who I'll borrow from, and that's decided by the cost of funds of each of these, be it fintechs or the banks. Given that banks as a whole have a good scope for the foreseeable future, taking questions on top three, HDFC, ICICI, Kotak should be safe bet. So we can't categorize anything as safe bet or risky bet because we're all in the market. So uh, markets are very volatile. I'll have to give that disclaimer. So HDFC, ICICI, Kotak, and even Axis, we continue to hold in our TRUBLU portfolio, and we are all constructive, very positive on these four banks. Do we see one single winner in the top three, or there is room for all three to win? We feel that all three, there is room to win, just that each of them have their own issues. So Axis had the City merger that's been done now. HDFC Bank had HDFC Limited merger that's been done now. Kotak still has a overhang in terms of the succession planning. Uday Kotak has quit as the MD CEO, so someone will have to replace him. So that overhang is there. ICICI is clear; they don't have any overhangs. As long as Bakshi is there, they'll continue to execute well. So we feel that all four can win. It's not just one who can win because they're all equally competitive. All of their ROAs, Axis is slightly lower at 1.7% ROA. The others are at 2% kind of ROAs. So all of them are very similar, and the valuations also. If you see 3 years ago, Kotak and HDFC Bank will have traded at a premium. Now everybody is growing at the same rates. Everybody has the same ROE. Just that these non-operational merger issues that we spoke about, the succession issues that we spoke about, the rest are all, they're all the same, level playing field for all four. So I don't see a single winner. We're very positive on all four. What are your views on IDFC First Bank, or another hot bank? So it's not part of our TRUBLU portfolio because we invest only in the large caps. And again, very early days about IDFC First. I'm not very sure of their credit costs because it's a very new bank. They've just started underwriting loans, so we'll have to give them time to showcase their underwriting abilities in one cycle or the next cycle, because if they're making their NIMs, net interest margin, is 7%. That's as good as a microfinance loan. But there's the question of them being a bank, so it's for high risk, high reward kind of investors who should look at IDFC First. We're not very sure about it. Is it good time to shift from small caps to large caps? Someone is starting afresh. How much do you suggest to invest now? So it depends on your risk-taking appetite, right? If you're very bottoms up and you can continue to stay invested in small caps where valuation is comfortable, but if you're starting fresh, I think currently the valuations are in favor of large caps. Dear all, is it the right time to invest in debt market? Based on duration, I would say you'll have to be. So we might have another rate hike, but we could peak at the next rate hike or even at these current levels. So you will have to decide what your duration is. If your duration of the time horizon is 1 year, you can invest in liquid funds or in money market funds. But if your duration long and you will hold till maturity, then it makes to go long duration. That is, say, 5 years, 7 years, and you're also getting FDs. at very high rates. So even the large private banks are offering FDs at 7.5%. So it is a good time to park some of your money in. But we've already seen that large cap segment is undervalued, especially banks and some of the other pockets. So you can as well invest in equities, large cap equities. I think I've answered all the questions. I'll just give it 2-3 minutes to see if there are any further questions before wrapping it up. Views on valuation for these top 3 banks. Should we wait for more correction to happen? Sir, we don't want to time the markets. We're not, even if we're good at timing, we don't want to time the markets. So we keep buying incrementally whatever fresh money that we're getting. We are buying into all the top 4 banks where we have valuation comfort. Why do some of your other PMS teams have no banking exposure? So that's the way we have designed our ecosystem, where the Solitaire, which is our flagship fund, we don't have any lending exposure. We do have other exposure in terms of financialization themes that we spoke about, be it life insurance, be it general insurance, be it AMC. There we have significant positions. We are not invested in banks there or NBFCs in Solitaire because all of these are leveraged entities, right? One bad cycle, things can go to the other extreme in terms of valuation, and market will beat down these entities. We have seen that in the past. In 2018, as Bank and DHFL crisis happened, the entire sector was derated, right? So we don't want to be present in leveraged entities, not just banks. We will not be present in any sector where companies usually take up leverage or debt to do their business. So that product is designed in such a way that we don't want to take leverage. Your view on richly valued NBFCs like Chola Finance and Bajaj Finance, do they justify it? So if you see Bajaj Finance career or in the last 10 years, they've traded at high multiples like 8x price to book, 10x price to book. Again, it goes back to my thumb rule, right? So if they're doing 20% ROE and you subtract 10% from it for the cost of capital, they're adding 10% economic value, right? So you divide that by 2, which is the thumb rule. So Bajaj Finance can trade at 5 times price to book. But what's happening now is, in the last 10 years, they had a guidance of 35% growth in AUM, which they have brought it down to 25%, right? So on a relative basis, if I have HDFC Bank and ICICI Bank growing at 17-18%, and then I have Bajaj Finance, which is growing at 25%, why would I pay 8x price to book? Right? So the growth has narrowed down, the ROE has narrowed down. Bajaj Finance ROE is roughly 20-21%. But if the large banks can give me that ROE, not exactly 20%, but I'll take 17-18%. So why not the banks themselves, and why is Bajaj Finance? But we do have Bajaj Finserv in our portfolio, where we are very constructive on their insurance business as well, their insurance subsidiaries. So Bajaj Finance is very good. I love what they're doing, but we wouldn't buy at any price. We'll want our valuation comfort. And Chola also, they're doing very well. So Chola, they used to be focused on one single product. Now, in the last 10 years, they've diversified. They were incubating a lot of new lending products itself, right? Okay, and that took some time. And the seeds that they
Yeah.
planted in the
Ah,
last decade is playing out
check.
now, and you're seeing that in valuation currently. Right, both the franchises are very good. Bajaj Finance is part of True Blue Universe, but
Attend madam
Chola
company
isn't.
repair
It's a it's part
57.
of Nifty Next
57.
50.
Attended. మొత్తం 70 మెంబర్స్ రిజిస్టర్ సో
Can you throw some light
90
on IOB? It's trading high.
it's an opt-out.
Like I said, sir, so you'll have to be specific in PSU banks. You can't just go out and buy the entire PSU space or the bucket. You'll have to look at what's the CASA of all these PSU banks, right? So there's some small PSU banks also which have very high CASA, which can compete with the private banks, because cost of funds is everything. Nobody talks about cost of funds, but cost of funds is more important than the growth rate that these banks are showing, right? So I don't want to take any names, but even within the tier 2 PSUs, there are some banks where the CASA is very high, as even better than some of the large private banks. So they can continue to do well. So how do you see SBI cards, which is the only credit card play in the market? Uh, SBI cards makes insane ROE, right? They make 25% ROE, return on equity. So they lend 100 rupees. On their net worth, they'll make 25 rupees, which means, so how cycles work is when there is high ROE, competition will come in. They'll try to grab that piece of market, right? So that's what happened in ICICI Lombard. ICICI Lombard used to make 20% ROE, was growing at 20% ROE, but competition came in. ACO came in, Go Digit came in. They wanted a piece of that profit pool. So market derated ICICI Lombard. So currently, SBI cards is priced to perfection. Market is thinking that SBI cards will continue to make 25% ROE, which we don't think so. The case here is India is at less than 10% credit card penetration. Australia and US are at 80-90%. But we did not go the path of US and Australia, because we have BNPL, we have UPI, we have credit on UPI, right? So there could be other forms of credit card. I mean, the form and the nature of credit cards might change. They will not necessarily be cards, right? The way we borrow and spend, transact could change. And SBI cards is priced to perfection. So there's no point chasing it, because we don't have any margin of safety there. And also, like someone like IDFC First, it's trying to disrupt that market. Currently, SBI, I think they charge 36% and above on the credit card revolver loans. If you pay within your due date, you'll not be charged. But if you revolve your credit card outstanding, then SBI gets to charge on it. But IDFC First is trying to disrupt that market. They've been gaining market share in the last few quarters. If you go to the RBI's credit card new issued data, IDFC First has been gaining market share. They're trying to disrupt the market. So one, there is incumbent disruptor. Two, there could be other forms of credit card through your BNPL, UPI, and so on. So it's a very dynamic situation. I'm not saying they're not good. They're very good. Just that they're very good because they have their captive base. All they can 25 crore customers of SBI can be given credit cards. That's the kind of market potential they have. But they'll have to execute. So there's a lot of risks there. There's no margin of safety. Do you have any valuation courses, any sessions in the future for the beginners? No, sir. Currently, we do not have any. We manage money directly, and we do take financial planning. We do financial planning for our clients. We can do that, but we don't have any valuation courses or educational content. You can keep attending our for each product. We'll have webinars every month. We also do non-product webinars. Like last month, we did one on gaming sector. So we'll keep doing this webinar. You can participate in this webinars. What is your view on IDFC First Bank? Do you think it is overpriced now? It is pricing in some of the future growth, and there's a lot of focus on one man, the MD CEO, Vaidyanathan, right? And they'll have to keep executing. They'll have to continue doing, and they'll have to meet their guidance of 18% ROE to sustain these valuations or even re-rate from here. Again, like I said, it's not part of the TRUBLU product, but we have to give a view. We'll have to wait and see how their vintage, in terms of credit costs, in terms of their loans, evolve over a period of time. They're like a high risk, high reward kind of plans where we don't want to participate in. How do you see CAMS and CDSL as a proxy to growing AMC and capital market respectively? Again, they are good proxies, but they're all priced to perfection. So we used to have CDSL in our flagship fund, Solitaire. We don't have it anymore because we are not comfortable with the valuations. Again, it all comes down to valuation and what part of market cycle we are in. I mean, we are not going back to work from home, people opening demat accounts, trading from their homes alongside their work. That will not happen again. So the growth will not be exponential. It will be kind of linear going forward. But market is not pricing in a linear growth, but it's pricing in an exponential growth. And in terms of CAMs, so there's a new proposals that SEBI might come out with for mutual fund and AMC companies. We are still not sure how much CAM's margin will be squeezed by the AMCs or the manufacturers of mutual funds. Again, we don't have valuation comfort there. CAMS is trying to get into account aggregator. They have their own account aggregator. We are still not sure of the business model as to how it will evolve. But they're very good companies. They are part of our tracking universe, but valuation. Thank you, Arun. I think that's it. Tarun, can we wrap up?
Yes, sir. Yes, we can. Thank you, everyone, for joining today. Hope you all had a nice session. Thank you, sir. Thank you very much for such a beautiful session. Thank you.
Thank you, Tarun. Thank you, everyone. Good day and good weekend.